you believe the U.S. economy is in a slowdown mode? And if so, by how much? Or if not, why not?
Well, let's put things in perspective. At the end of this month, it'll be the longest economic expansion since 1854, according to the National Bureau of Economic Research.
Zachary Taylor.
This is the most exactly. This is the most anticipated slowdown I've ever heard of, because we keep talking about it, and yet we continue to proceed. Consumption is strong. Retail sales are surprisingly good. The last June employment figures, more jobs, twice as many jobs were created as we needed to continue job expansion. So on the consumption side, as pointed out earlier, excellent. Monetary conditions are super accommodative. Stock market at an all-time high, interest rates very low. The prospect of perhaps another rate cut, even though I disagree with that if I were at the table. Things are very, very good, and yet you're talking about freight and all that. The Cass Transportation Index, which everybody starts quoting now, is weak, and it's been weakening and weakening and weakening. So we're going to have to see. The one thing I felt when I was at the Fed, there was an overemphasis on two things. One is there's more agricultural data in this country than any other database. That's only 1% of our economy. And then all the manufacturing indices, manufacturing data, it's important. It's 11% of our economy. The consumer and services drive the U.S. economy, and we're still continuing to grow. And with all due respect to my former colleagues at the Atlanta Fed, as you know, that's a very volatile number, and it hasn't been at all accurate in forecasting what's actually going to be reported on GDP. So I think we're probably slower. One would expect it to slow down. At the same time, I don't see us turning into negative territory. And again, financial conditions are hyper robust right now. So things are pretty good, I would say.
Maybe we've gone from 80 miles an hour to 75 miles an hour. And by the way, nobody's picking on the Atlanta Fed. There's good people down there. I'm just saying the number has been a little bit wild here, and they'll probably get a phone call after.
No, it has. It's not supposed to. It changes every day, by the way. It's the GDP Now number. So
it is.
You're not picking on the Atlanta Fed.
That's fair enough. But, I remember in December, Richard, that you were saying that, the rate hike may be the right thing to do and that we should have a couple more rate hikes.
Right.
I mean, that may have been a policy mistake, but do you believe that now we need a rate cut at the July 30th meeting?
No, I don't. I mean, all the conditions they were worried about have not materialized. In fact, again, the market's raced upward in equities. Interest rates are low. Mortgage rates are low, even though they've come up a few bips in the last couple of days. Consumption is strong. Job creation is strong. What I worry about here, they only have so many coins in their purse. There are actually 8 coins that they want to go back to the zero bound. I wouldn't be pulling those monies out and spending what is in my meager purse until it's uber clear that things are looking bad. And it's not clear right now. So, again, they may end up cutting. That seems to be the rhetoric right here. But if I had those coins in my purse, if I were still sitting at the table, I would not be in favor of cutting rates here. The market has been determining the shape of the yield curve. The market has determined how low rates are. I don't think the Fed controls the yield curve more than a year out right now, the way they've constructed their portfolio and the way they're dealing with the base rate. So things are good.